And inflation has been running hot since last spring, since April, May of 2021. And some of the monthly numbers have come in, whether it's the producer price index, PPI or CPI. They're printing numbers that are the highest in 30 years or sometimes longer. So we're going back to, if not the worst of the 70s, at least the early 1980s, but in some cases longer for these inflation numbers. So inflation is showing up. So that's undeniable. You can argue about the forecast, but it's here. When it first turned up in kind of April, May, June, even July 2021, you could say, and there was good support for it, that a significant part of it were what are called base effects. And you have to know how they calculate inflation. How does the government do it? They look at the monthly data and they compare it to the same month the year before. So it's a year-over-year comparison, but only for 1 month. Then they take that number and they annualize it. So whatever it is, they times 12, or there's a little more to the math, but basically they annualize that. And that's the number you read about in the headlines. Well, if you say, okay, April, May, June 2021 were hot. Well, what was going on in April, May, June of 2020? Because that was the comparison. Well, the economy has shut down. I mean, literally shut down. The worst collapse since 1946. And one of the worst in American history. So we didn't just have low inflation in 2020. We had deflation. Prices were going down. So when you get to 2021, the year-over-year comparison, of course it was going to go up. Of course that was going to be more than usual. That was completely expected. It's hard to disentangle what I just described as the base effect from it's called real inflation, real price increases. But the best estimates were about half of it was a base effect. So if you were seeing number of 6% inflation, that was about what it was. You could say, well, it's kind of 3 real and 3 base effects because we're comparing to a very weak year. However, as you got into August, September, October, the base effects started to go away, which is, you say, well, what was going on in August, September, October 2020? Well, that was one of the strongest periods of growth in U.S. history. That was the other side. It went down and then it came back up. It didn't make it all the way back up. But yeah, that was a strong rebound in the third quarter of 2020. So you would expect, so therefore the base effects went away. But the inflation remained hot. It didn't fade as much as I thought it would. It was like, okay, well, the base effects are gone, but the inflation is still there. In fact, by some measures, it's even worse. So here we are early in 2022. And as of the most recent data, we don't have the December data yet, but we have November data and we have some other indicators, and it's still a little bit hot. So now we're at a point where you say, okay, is this real inflation? I would define real inflation not just as numbers, but is it persistent? Is it pervasive? Is it across the board? Is it feeding on itself? Is it raising expectations? That's something to worry about. Or are there some specific causes we can point to and say, yeah, okay, that's causing a little inflation, but it's going to go away. So that's the debate. It's the biggest debate in economics right now. I'll give you my view, but be clear that there are definitely two sides of the coin, no pun intended, but definitely two sides to the debate. And in particular, you say, okay, let's disaggregate a little bit. The other numbers have been hot, but what's driving it? Well, one of the number one things are energy prices. Well, okay, but what was Biden's energy policy from the day he was sworn in? He shut down the Keystone XL pipeline. He handicapped fracking in Texas and Pennsylvania and other states. He prohibited new oil and gas leases on federal lands. He limited offshore drilling. And he did a number of other things, all of which were designed to basically handicap the oil and natural gas industry. Well, so my point is, energy is real. You need it. I fill my tank just like everybody else. I'm not immune to this. Used cars. But when you have a couple of things like that are driving the whole CPI, you have to step back and say, wait a second, is this widespread inflation? Are expectations changing? Is this sustainable? Or is this just a short-term spike in a couple of key indicators? And rental equivalent housing is another one. There's a housing shortage because, zoning requirements, and BlackRock's buying up all the houses, and there are other reasons for that. And so as I look at it, what I see is, the inflation numbers are up. There's no question about it. But this is not the kind of inflation we had in the 1970s. In the 70s, it was, you got a raise every 2 weeks. I was kind of starting my career, and we get 3 or 4 raises a year just to keep up with inflation. It's like, okay, thanks for the raise, but prices just went up 13%, which they were at the time. This is not that kind of inflation. In the 70s, it was everything. It changed expectations. It was what's called cost push inflation, which is workers are like, well, you got to give me a raise, and unions were stronger, but even non-union companies said, yeah, I do actually. That's not true today. Workers don't have the bargaining power. Labor force participation is low. And like I say, it looks like a couple factors that are going to run out of steam, and the economy is slowing, and then we kind of can get into the whole supply chain debate. So just to sum up, I would look for disinflation. I'm not calling for deflation. Deflation is when prices go down. I can't rule that out, but I don't see that. That's not my intermediate term forecast. But disinflation is. I see these numbers going down from 6%, 7% annualized, which is what the government's showing. Getting down to the 4% level, and eventually down to the 2% level, which is where it was from 2009 to 2019 during that 10-year expansion during Obama and Trump. And there wasn't much difference between Obama and Trump in terms of growth. I know, Trump claimed the greatest economy ever. Well, that's fine. That's a talking point. But the fact, if you look at the numbers, the Obama and Trump economies were, kind of the same, right around 2.2% growth. Inflation was between 1.6 and 2. Rarely, if ever, touched the Fed's target rate of 2%. That's where it's heading again. So not deflation, but disinflation. This inflation bubble is going to go away. Disinflation is inflation at a lower rate. So now you still have inflation, but if it goes from 8% to 6% to 4% to 2%, which is what I'm saying, you still have inflation, perhaps inflation of 2%. And that's not trivial. Look at the value of the dollar and a half in 35 years. So it's, by the time you're, most people are young adults at the time the kids are in college. It's about 35 years, so or less. So that's real. But going from 8% to 2% is a big deal for a couple of reasons. Number one, it means that 8% number is not sustained. If it is, if I'm wrong, I don't think I'm wrong. I wouldn't be giving this analysis. But if I'm wrong and inflation goes 8%, then it's probably on its way to 15. So that's a completely different scenario. It's not the scenario I see. But you have to watch.
Now what you define as hyper or super inflation then?
Well, you're getting close to hyperinflation at that point. And again, Kim, just to be clear, I do the analysis. I have a view. I look hard at the data. I have models. So I exercise a lot of care on this, but I don't just ignore the alternatives. Sometimes you're wrong, you have to pivot. So yeah, we should all be watching for signs of inflation. I don't see them. I see disinflation, which means you still have inflation, but it's at a much lower rate. But there's a world of difference between, let's say, 1.8% inflation and 6.8% inflation. Those are completely different worlds, because one is much more manageable, but it also changes expectations. And expectations are the key. The Fed doesn't control inflation. Everyone's like, oh, they print money, you get inflation. That is not true. It's not true in prices. It might be true in asset prices. It might be true in stocks and bonds and real estate, but that's not the consumer price index. That's not what the Fed looks at. That's not what most economists or many economists mean when they say inflation. They're asset bubbles. Money printing can lead to asset bubbles, but it does not lead to price inflation unless velocity picks up. Velocity is a psychological phenomenon. So if you change the expectations and change the they change the psychology, and change the velocity, yeah, you will get inflation, but I don't see any of those things changing. What I see is this runs out of steam and we get back down to below 2%.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.